Welcome to this explainer. Today, we're tearing into a brand new daily strategy report from August 24th, 2026. This isn't just your standard price recap. We're looking straight under the hood at structural liquidity to figure out why Tier 1 institutions are completely clashing on their research right now. We're going to break down precise portfolio weightings and see exactly how macroeconomic plumbing is dictating digital asset prices today. If you want to know how the smart money is really positioning itself, well, you're in the right place. Let's get into it. Here's our agenda for today's briefing. We're starting with macro and liquidity shifts, moving into that massive institutional view clash, then digging into on-chain microstructure. After that, we'll hit narrative and alpha hunting, lay out a strategic action plan, and wrap up with the final verdict. Section 1, Macro and Liquidity Shifts. All right, I want you to look right at this number, 5.34%. On August 21st, the U.S. 30-year Treasury yield hit a 19-year high, touching exactly that mark. So, why does this matter to us? Well, in the global financial system, a yield that high on long-term debt acts like an absolute black hole for liquidity. It's an unsustainable limit. When the risk-free rate spikes like that, it forces a massive structural repricing of risk premiums. It literally sucks capital right out of riskier assets across the board. But as you might have guessed, the government just couldn't let that stand. In direct response to that 19-year high, the U.S. Treasury stepped in and intervened. They urgently doubled their long-dated bond buybacks, taking them from $2 billion to a minimum of $4 billion per operation. By acting as the buyer of last resort to pump fiat liquidity into the system, they instantly compressed that dangerous yield back down to 5.19%. And that right there, that was the exact moment the market's discount rate shifted. And this timeline perfectly proves the immediate transmission of that fiat liquidity straight into digital assets. Check this out. August 19th, the Treasury announces the $4 billion buybacks. Literally the next day, August 20th, Bitcoin acts like a giant liquidity sponge, instantly breaking above its critical 200-day moving average of $69,000. By August 22nd, it peaks at $79,200 before consolidating around $77,116 today, August 24th. So this wasn't some random crypto rally, right? The report shows it was a direct mechanical reaction to the macro plumbing. Section 2, Institutional View Clash. Because of that sudden liquidity jolt, the smartest people in the room are severely divided right now. On one hand, you've got Standard Chartered projecting a parabolic run. They're calling for a $100,000 Bitcoin target by year-end based on ETF inflows. And they're heavily backing DeFi, saying Uniswap is going to hit $1 billion in true value locked. But then, on the exact opposite side, you've got VanEck and Bitfinex flashing some serious late-stage bear market signals. They're pointing to on-chain transfer velocity dropping to a 7-year low and warning of structural decay, predicting sideways movement at best. So someone is very wrong here. How do we resolve this clash? Well, the report anchors its analysis to cold, hard on-chain data, specifically the short-term holder realized price. This metric tells us the average acquisition price of coins that have moved within the last 155 days. Right now, that forms a critical structural support band between roughly $67,176 and $69,007. Now, with Bitcoin currently sitting around $77,000, the authors argue we are dangerously stretched above that true structural support. Basically, the price has temporarily outpaced the actual base of buyers. Section 3, On-Chain Microstructure. Let's do a forensic dive into the on-chain data here. This liquidation data from Binance is incredibly telling. It completely confirms that the initial breakout past $69,000 was heavily driven by a mechanical short squeeze. We're talking $7.73 billion in short positions violently liquidated. When you forcefully wipe out the shorts like that, they have to buy back at market price, right? Which launches the asset upward. But look at the long liquidation sitting right below at $7.58 billion. The upward momentum from that short covering is mostly exhausted now, which leaves a massive, highly leveraged cluster of longs totally vulnerable to a downside wick. To make matters a bit more cautious, let's look at stablecoins, the actual fuel for a true bull run. Global stablecoin supply has actually contracted by 4.5% from its May peak. We're currently sitting at a $303.1 billion total market cap, with Tether still holding the dominant share at over 60%. The takeaway here is absolutely crucial. There is an absence of fresh, broad, retail liquidity entering the system. The fuel tank isn't filling up. If anything, we might be running on fumes. But here is where the bearish thesis from VanEck gets it slightly wrong, according to the data. They are focusing on what the report calls an on-chain illusion. Yes, on-chain transfer velocity is at a 7-year low, but that completely ignores the off-chain reality. Institutional capital is flowing in, but it's bypassing public blockchains. We're seeing Citi launch native Bitcoin custody, Coinbase securing ADGM licensing for tokenized securities, and Morgan Stanley rolling out new spot ETF wrappers. Smart money isn't leaving a footprint on the public ledger right away. It's hiding in traditional off-chain infrastructure. So, putting this microstructure together, the report outlines a clear 3-step transition. Step 1 was that violent deleveraging event, the mechanical short squeeze. Step 2 saw real capital taking the baton, bringing in $1 billion of spot ETF inflows over just 3 days. And step 3 is the on-chain spot apparent demand finally crossing back above zero, signaling that real, unleveraged buying is finally recovering. We're effectively shifting from a chaotic squeeze into a phase of stable institutional spot accumulation. Section 4. Narrative and Alpha Hunting. Now, if you've been sitting around waiting for alt season, you really need to hear this number. 59.8%. That is Bitcoin's current dominance, and it is effectively vacuuming up all the market's capital. According to the structural analysis, this single metric completely destroys the retail narrative of an imminent, broad-based altcoin season. The data is telling us you can't just throw money at random small-cap tokens and expect a rising tide to lift all boats right now. It's just not happening. Because of that, capital allocation has to be surgical. You have to restrict exposure entirely to sectors with proven institutional product-market fit. The data points us to 3 distinct areas for rotational alpha. First, real-world assets, led by tokens like Ondo, which just pushed the sector to a $32.2 billion market cap with a recent 10.7% return. Second, Oracle networks like Chainlink that are securing these assets, especially with the new RLUSD integration. And third, decentralized AI compute, specifically BitTensor, or TAL, which is sitting on a pending ETF approval catalyst. On the flip side, the strategy report is crystal clear. Aggressively cut your portfolio exposure from Layer 1 laggards that are suffering from structural failures or delayed roadmaps. Look at Solana. They recently suffered a massive 28.83% node dropout due to a routing failure, which caused Standard Chartered to slash their price target by 46% down to $135. Then you have Ethereum, where the highly anticipated Glamsterdam upgrade has been delayed 6 months to Q4 2026. And Uniswap, its true TVL is sitting at just $506 million, severely lagging behind those big institutional projections. Cut the deadweight. Section 5. Strategic Action Plan. Based on everything we've covered, the report establishes 2 strict portfolio rebalancing protocols for fund managers. Scenario A is accumulation. Maintain your long exposure, but only if spot demand remains positive and ETF flows sustain their momentum, holding the price above $77,000. But you have to be ready for Scenario B, downside reversion. Funding rates right now are extremely overheated. We're talking 88 out of the last 98-hour intervals being positive. That means longs are paying a massive premium. If that structure breaks, the report warns it will trigger a cascade right back down toward that $7.58 billion long liquidation cluster we saw earlier. So hedge your positions. We also have to talk about the black swan tail risk. The big unpriced risk right now is counterparty failure in self-custody infrastructure. Just recently, we saw a $130 million exploit on cold card hardware wallets, a vulnerability that sat unnoticed for 5 years. And what was the market reaction? A massive $626 million of fearful capital immediately fled right back into heavily fee-burdened centralized ETFs. The pendulum is swinging hard away from self-custody and straight into the arms of Wall Street custodians because of these security fears. What happens if more of that infrastructure fractures? Section 6. The Final Verdict. Okay, according to this briefing, if there is one singular data point you need to watch on your screens tomorrow, it's the true market mean price. It's currently sitting at $83,000. This represents the active investor cost basis, and a definitive breakout above that $83,000 level is absolutely required to confirm a full macro trend reversal. If the market fails to breach this level, the report expects an immediate and painful reversion, right back down to those mean support levels we've been talking about. So what's the final verdict from this strategy report? Well, I'll quote them directly here. Execute a defensive allocation into real-world assets and oracles while strictly capping high-beta altcoin exposure beneath the 59% Bitcoin dominant ceiling. Essentially, strip away all the retail noise you see on social media, respect the macroeconomic liquidity boundaries set by the bond market, and position defensively within proven on-chain revenue generators. Don't fight the liquidity structure. Use it. So I'll leave you with this. Based on the data we just walked through, are your portfolio allocations ready for a structural reversion, or are you just hoping the squeeze lasts forever? Thanks for joining me on this explainer, and I'll catch you next time.